Hello everyone, welcome to the first episode of NIBM Podcast Series, NIBM Insight. In today's episode, our student Sohan is going to interview my faculty colleague, Professor Sanjay Basu. Professor Sanjay Basu is Dean Research and Editor Prajnan at National Institute of Bank Management. He has published in noted international journals on game theory, market contract theory, and market risk. In this episode that you're going to watch today, he's going to talk about the SVB crisis. What are the lessons that the regulators around the world should learn from this crisis? Professor Basu also points out that Indian regulators, by not linking the bank size to the Basel compliance, has protected the Indian banking industry. But he sounds a note of caution for the NBFC sector going forward. So keep listening to this very insightful episode.
Well, hello everyone. Hope you had a nice day. I am Sohan Chaudhari, a student of NIBM from batch 2022-24. Starting today, we bring to you our NIBM's own Insight Podcast Series, wherein we talk to our professors about the issues that matter. We have today with us Professor Sanjay Basu. He is the Professor of Finance here at NIBM. How are you, Basu, sir?
I'm fine. What about you, Sohan?
Well, sir, I'm very good. Thank you very much. Today, for the first episode of our NIBM podcast series, we are going to discuss about the issues of SVB failure. That is the Silicon Valley Bank failure that took place the last month. And our first question to you is, what do you think were the reasons for the failure of SVB Bank?
Thank you, Sohan, for this opportunity. Very good evening to one and all. And the Silicon Valley Bank problems had been brewing for a very long time. When interest rates were very low in the US, even before the COVID pandemic, after the global financial crisis, Silicon Valley Bank depended on zero-cost deposits. Now, this is clearly given in their annual reports. They funded their asset growth with zero-cost deposits to minimize, as you can understand, their interest cost. Right. A small chunk of their deposits paid interest, and the proportion of long-term deposits was minuscule. They invested or deployed these deposits in long-term bonds, which earned higher and higher profits as interest rates continued to decline. However, from 2022, when interest rates began to rise, these old bonds became unattractive. Fresh bonds at higher rates became more popular. Therefore, Silicon Valley Bank made large losses to the tune of almost $300 million in 2022 itself, from a profit of almost $761 million. So that's a turnaround of almost $1 billion worth of losses within 1 year, as a result of which, even before 2023, they lost around $45 billion worth of zero-cost deposits, as market rates were much higher. So therefore, with the rise in interest rates, they made large losses on their bond portfolio, and they lost large chunks of zero-cost deposits, which they tried to replace with more interest-bearing deposits and a bit of long-term debt, so their interest cost also went up.
Right.
However, this was not the end. The market was not calmed. So in March 23, when they tried to sell bonds worth $21 billion, they made large losses worth $1.8 billion. That was the trigger for the collapse. And they lost deposits worth $42 billion once more within a very short span of time. So therefore, a sharp rise in interest rates, right, initially led to large losses in bond markets, withdrawal of zero-cost deposits in 2022, which was repeated in March 2023 when they made large losses on their bond portfolio and lost deposits worth $42 billion.
According to your answer of the first question, we learned that the SVB collapse was largely based due to interest rate risk and their LM mismatch. But what do you think are the lessons that the US banks and regulators can learn from this?
You see, the problem with much of the US banking industry is, as this case study shows, many banks and institutions which were small, that is less than $250 billion of asset size, did not conduct adequate stress tests. Right? So these stress tests would have led them to build up their liquidity buffers, would have forced them to anticipate the adverse consequences of interest rate shocks, right? But they considered these Basel III stress tests as a matter of regulatory compliance. They never felt that these events or episodes could actually occur and hit their balance sheet and P&L. So that's the first lesson. Whether a bank or a financial institution is covered in terms of regulations by a series of risk management guidelines, it should conduct scenario analysis and stress tests on its own. Risk management is not a matter of regulatory compliance. Second, their own scenario analysis based on the Basel tools that they were subjected to continued to show that they would make large losses in net worth if interest rates rose. These early warning signals were flashed even while interest rates were low. So SVB did nothing to offset or hedge these losses. They did not look out for longer term liabilities, right? Which would stabilize the outflow on the liability side in case such an outflow occurred. They did not look out for short-term floating rate assets, nor did they tap the active interest rate derivatives market, right, to absorb any potential losses. Now they say, in the wake of the crisis, that they would lengthen the maturity of their liabilities, depend on more floating rate assets and derivatives to protect them from rising rates. But the horse seems to have bolted. Their asset liability management was very poor as well. They had low credit risk, one of the lowest among their peers, right? They were also invested in long-term safe government securities. But this safety is from default risk, not from interest rate risk or liquidity risk. So as I explained earlier, they were subject to a vicious interest rate and liquidity risk cycle, where rising interest rates worsened their liquidity positions and liquidity pressure increased interest cost on the liability side. Right? A final lesson. So these lessons are for all banks in US and Europe, which are not covered by Basel regulations, right? To conduct stress tests on their own, to change their portfolio profile in anticipation of interest and liquidity shocks, and pay more attention to asset liability management. The final lesson for US regulators is that no bank is too small to fail. Right? So therefore, we have seen that the Silicon Valley Bank was the 16th largest bank in the US. It collapsed when interest rates rose, right? And its collapse had severe repercussions even in Europe, right? With the failure of the Silicon Valley Bank, shares of Credit Suisse fell by more than 30%, a shock from which they couldn't recover, right? They had to be taken over by UBS. So there was global contagion. The point I wish to make therefore is, when these stringent risk management guidelines or standards are introduced in the US, there should be no discrimination in terms of bank size. Because the failure of even small banks can have severe repercussions, not within the banking industry in the country, but also across the world. Right? As I keep on saying, when depositors and savers lose faith in one set of banks, they tend to lose faith in the entire banking sector. Okay.
Well, sir, what do you think were the implications specifically for the Indian banks, and what were the lessons that Indian government and regulators should take from this?
Indian banks have been protected right from this crisis till this point, right? Because these risk management guidelines were introduced by RBI regardless of bank size. So all scheduled commercial banks were made to conduct these stress test scenario analysis, right? And build up their liquidity buffers in line with Basel III standards, right? However, we should keep in mind two lessons. Much of the NBFC sector, right, is still outside the ambit of Basel style regulations, right? And here the Reserve Bank of India, right, should not introduce regulations only for the systemically important NBFCs.
Right.
Even relatively smaller NBFCs can create a lot of trouble because they're interconnected with the rest of the financial sector, right? So NBFC regulations should be aligned with those of the banking sector. That's point number one. And point number two, we should realize that history repeats itself. Okay, whatever has happened in the US in the past, in the 1970s or 1990s, repeated itself as the Silicon Valley Bank failure episode. Similar cases may occur in India as well. Right? So we should be vigilant in India that similar crisis should not occur. Whatever has happened in the US, right, may happen in the Indian banking sector as well, right? There is no room for comfort, right? That's all I would want to share.
Okay. Well, sir, thank you very much for sharing your valuable insights. And I'm sure that our audience have gained a lot from it. And hereby we would like to conclude this podcast.
Thank you very much, Sohan. Thank you for this opportunity, right? I wish you, all your classmates, right, and the entire audience, right, who I presume, most of whom I presume, right, would be budding bankers, right, students of finance, the very best in their personal and professional lives. Thank you once again for this opportunity. It's been a pleasure to share my views with you. Thanks a lot.